Remember, with the funding, there is this thing that's called a capital structure. Funding institution, okay, they'll tell you that they are funding based on viability, but I can tell you now, they're lying to you. There are certain things that they also look at. They're looking at the structure. Sometimes the structure, when they're talking about the structure, is how much debt can you load into this business? Banks, they hardly do startups. They might claim they do startups, but really they don't. That's just for marketing purposes. They don't do startups. What they do is existing businesses. They want to see your bank statement. They want to see your banking. They want to see the cash flow that goes into your business so that they can assess if the activities that you are doing are justifies them giving you a loan. So that those are the main three things that our banking institution are looking at. Before we jump into the lesson for today, here's the clip on how our platform works.
Good day. Welcome to our platform that simplifies the business plan development process. We will guide you through the platform and will try to simplify the business plan development process. We are from a school of thought that believes that a well-developed and accurate business plan is an important tool in an entrepreneur's toolbox. 1. To identify, assess, and manage business opportunities and the related risks. 2. To source funding and recruit key partners such as suppliers, customers, and key employees. We have identified three main challenges with the business plan development process, and they are 1. Too academic. It requires research and formal writing. 2. More specifically, the numbers and financial statements. This forces the entrepreneur to hire business advisors and or accountants, which creates a third problem. 3. Cost. Hiring of consultants is costly, and this becomes a gatekeeper to entrepreneurship. We developed this application tool, which we believe it addresses the above problems, and this is our first step in our mission to democratizing entrepreneurship and access to funding. At some point in your life, you have to answer your calling to live a fulfilled life. If entrepreneurship is your calling, we are here to simplify the process for you.
As the saying goes, many were called, few were chosen. Many have tried entrepreneurship, few succeed. You are warned. Entrepreneurship is not a children's game. Entrepreneurship is not for the faint-hearted, and it is not for everyone. It must be your calling because it comes with headaches and pains. Entrepreneurship is a high-risk career. Depending on the research you read, between 70 and 90% of all startups fail. You must do your work before you jump in. You may become the statistics. If you really want to be successful as an entrepreneur, you should consider it your first occupation. Trust the process and invest the necessary time and resources required.
As I have said in the introduction, developing a business plan can be too academic and technical. To simplify all the concepts of the business plan, we are using 3 entrepreneurial movies as practical case studies. The first movie is The Founder, based on McDonald's true story. Second movie, War Dogs, 2 young men, tenderpreneurs, and Moneyball, managing an underfunded organization.
The movies are based on true stories, and they are focused on certain narratives rather than the intricacies of business management or entrepreneurship. However, we will extract as many lessons as possible. We believe that by using movies as a case studies will make it easier for entrepreneurs to relate to concepts that they are not familiar with.
We chose the 3 movies because they represent all the business models that exist. Value adding process. You basically have to think manufacturing. You put raw materials in one end, they go through the process, and a different product comes out at the end of the process. McDonald's business model is value adding process. Facilitated network. They are middlemen. They facilitate access to solutions, i.e., agents, tenderpreneurs, and network companies. They don't necessarily produce anything, but they just connect the problem with the solution. AEY's business model is a facilitated network. Solution shops, consulting businesses. You identify or they identify the problem and they customize a solution for you. The Oakland A's business model is a solution shop. A business can incorporate all the business models in one business. It is important to understand your business model. For example, RMK combines all the business models. This app takes entrepreneurs and produces polished entrepreneurs. That is value adding process. Facilitates funding, facilitated networks. And lastly, we provide post-investment support, solution shops, where we identify problems in your business to develop solutions.
Welcome to another session of our new venture creation series. Today we'll be looking at the Unistandard Finance a New Venture. My name is Malusi Mageta, the director and the founder of RMK Industries and Super Deal Maker. The session today is from the accredited qualification New Venture Creation, which is at level 4 and it's got 149 credits. And the session today is we focus on the Unistandard Finance a New Venture, which is the level 4 and it's got 5 credits. The purpose of this Unistandard is for the learners or the entrepreneurs that are making financing decision for a new venture. It doesn't have to necessarily to be a new venture, but if you are looking to finance your business or your entrepreneurship venture, this Unistandard is for you. Then what you look for, once we're done with the Unistandard, the learner should be able to determine the capital requirement of a new venture, should be able to identify and compare all short-term and long-term funding options that are available for a new venture and in our finance industry. You should be able to compile your personal income statement and balance sheet. You should be able to identify the required documents and the required processes that you have to follow when you are raising capital. And you need to know the alternative sources of raising capital. The Unistandard consists of 5 specific outcomes. The first specific outcome is to determine the capital requirement of a new venture. What does the business require in terms of funding? The second specific outcome is to identify and compare the funding options that you have as an entrepreneur, looking at the finance industry in the country, or not necessarily in the country, but the available financing options that you may have as an entrepreneur. And the third specific outcome is to be able to compile your personal income and expenses and your assets and liabilities statement, which are generally required for a new small businesses when they're applying for funding to see the income and expenses required for the directors. Mainly this one is for the directors of the company or the shareholders of the company, depending how close the shareholders are to the operation. So the funders wants to look at your income and expenses account and your balance sheet, depending on, for all the directors, depending on how many directors you are in the company. The specific outcome number 4 is to identify the requirements and the process of obtaining a selected funding option. So now here we'll be going through what is required, the documents that are required, things that you need to be able to identify, and going through the process of raising capital for a business. And the last specific outcome is for an entrepreneur to be able to identify the alternative sources of funding. You need to know what options do you have as an entrepreneur to raise funding. Okay, before we get into the textbook concept on financing a new venture or SMMEs in general, I just want to highlight, or maybe just to go through the South African financing or financial sector or industry landscape. Remember now, we're going to go into, call it a textbook concept, which assume a perfect world. But we know with our political history, we have a financial system that is not equitable. So I'll just go through into the challenges that different entrepreneurs will face. But our lesson today are for those in the perfect world. In South Africa, we have a different spectrum in terms of access to funding. You can have a white male in a metropolitan, and you can have a black youth female in a rural area. So the challenges that these two people are facing are not the same because of the environment that they are in. So now, normally the textbooks and the material that we generally go through, they assume that everyone is equal in our financial sector, or in our financial system. But it's not like that. So I'll give the worst case. The worst case is a male white person in metropolitan will face similar challenges that we're going to show you now. Because as I said, we're going to show you clips from our 3 case study movies, which is the Founder, the Moneyball, and the War Dogs. So those are the challenges that a normal white person in a metropolitan will face. But we also have the disadvantaged woman, youth in a rural area. They're facing totally different challenges in terms of accessing the funding. So first I'll start with just give you an example before we go in detail in terms of the curriculum. A white male in metropolitan will have his background is different. He's been exposed to a financial system in their background. You find that their cousin or their father, their uncle are running businesses. So they get exposed to a business environment at an early age. And that's one. The second one is they have the networks in right places. Because if you are raising funding, one of the things that are required is you need to have access to market. Do you have a market? That's the first question that a funder will ask you. Unlike a black woman in rural area, which is very difficult to secure a sustainable market, a white male in metropolitan will have called uncles or father or friends that he went to school with who will be able to give him a letter of intent or an offtake agreement to prove that he's got market for it. And the third one is funding requires security. So if you are based in rural area, you don't have ownership of the property that you are living in. Basically, you are on a PTO, which funding institution they don't consider as security. So you don't have collateral that you can give. But if you are in a metropolitan, you have a property that you can give as security, then that gives you an advantage when you are raising capital. That's the third advantage that the white male will have. And then on the other side, we have a black female youth in rural area. One, the exposure to business is limited. It doesn't have cousins and uncles and mothers or fathers that are in business that he could learn from young age. So business skills are limited from that angle. And secondly, the market, access to market. Because if you are looking for funding, the funders, they want to be sure that do you have a secured market that you will be able to service. So if you don't have an uncle or brother who owns a company that will be able to give you a letter of intent or an offtake agreement, you have a mountain to climb as a black female entrepreneur in rural area. And the third one, the most as well, which is most important in our financial system, is collateral. You might have a property in rural area, but you don't own that property. You don't have a title deed to that property. You can't put it as security to raise the funding. So those are the dynamics that we are playing with before you even come to the technical requirement of raising funding, which is our topic for today. So those people are dealing with two different challenges that they have to go through, and the approach obviously should be different. And instead of our financial system accommodate these two individuals, because I took the two extremes. Obviously, the example are extreme. I took the white male in metropolitan and a black female youth in a rural area. Yes, they are in betweeners there. But these are the two extreme examples. So our financial system, it doesn't cater for that disadvantaged black woman youth in rural area. They apply the same principles when they assess the funding, which is it becomes a challenge for more especially black South Africans to raise capital in our financial system. So if you are black, rural, okay, not necessarily rural, but if you are black, one, most of the time you don't have security. Two, you don't have the background or the experience or the exposure that will give the funder that comfort that you have the experience, you've been exposed to business, you won't make mistakes. And then three, obviously you don't have the network to give you market security or to give you those offtake or offtake agreements or letters of intent. So from that angle, you're like a blind person in a black room looking for a black cat. It's a challenge. So for generally what I normally advise, or when I'm facilitating, advise entrepreneurs, most especially black entrepreneurs, is to say you need to start first. You bootstrap your business, meaning you fund it yourself, you prove the concept, and then once you have proven the concept and then you have secured the market, then you approach a funding institution for funding. That makes it a little bit easier and it will reduce your frustration. So first is the bootstrap, which is one type of funding. Bootstrap basically means funding whatever the business that you want to start from your own pocket without raising funding, so that you can prove the concept first before you approach the financial market to raise capital. So that will give you knowledge. One, it will give the funder the confidence that you know what you're talking about because you would have tested the market. Yes, there are certain businesses that you can't start. What you do is maybe you buy and sell. If you want to go into manufacturing computers or laptops, for argument's sake, instead of wanting to set up a factory, the first thing that you do, you find a supplier which is affordable that you can buy at a reasonable price, and then you sell into your market. And then once you've proven that there's demand for this market, then you go into manufacturing. Because going to manufacturing without proving the market, it becomes a daunting task, most especially if you don't have the connections. Because if you go to bigger retailers, they won't give you an ear. Because one, you don't have the network in that space. You will be approaching them, calling them, and most of the time, it's not easy for them to trust you so that they can give you a letter of intent. So the best way is to bootstrap as a black entrepreneur. So that's the highlight to say. I just want to highlight that to say there are two different individuals at the extreme end. One is privileged and the other one is underprivileged. So the approach becomes different. And unfortunately, is the political or the situation that we find ourselves in as South African. So I just wanted to highlight that even when I go into details in terms of the requirements, you need to keep that in mind to say, as a white male entrepreneur in Metropolitan, it can be a little bit easier for you to raise funding because you will be able to secure the market. You can get offtake agreement from your friends or from your cousin or from your uncle. You might be able to give security because where you're staying, you have title deed. You can be able to give the title deed as security. And three, most of the time, okay, not all the time, but most of the time you are exposed to business, you are exposed to finance, how you manage finance, and then how the business are run. So in that case, you have the advantage. It makes it easier for you to approach funding institution with a startup. But if you are a black entrepreneur, you don't have experience in running the business. You don't have connections who can give you letters of intent or where they can give you market. Three, you don't have security most of the time. Okay, not all the time, most of the time. Because you are staying, the property that you have a big house on, you don't own it. It's on a PTO. And our financial system, they don't consider properties that are built on a PTO, which is permission to occupy, that you are given by the traditional council. Our financial institutions, they don't consider that as security. They won't take your big house as security. It doesn't matter how much you spend. But because you don't have a title deed, you can't use it as a collateral for your funding. So as you go through this lesson, just keep that in mind to say, if you are on the extreme right, whatever you don't have security, you don't have exposure, you don't have a secured market. The best option for you is to bootstrap from the beginning, and then you prove the concept. Once you've proven the concept, then you can approach funding institutions for funding. And yes, we have financial institutions. Okay, the banking system, which they are extremely strict in their funding terms. And then you have government institutions, which are called developmental funding institutions, DFIs, which they're supposed to be relaxed in how they assess the applications. But I've been there. I worked in that industry. It's not as easy as it is said on paper, or it's said on when they are meeting, they're calling these conferences. They'll tell you that they are funding based on viability. But the reality is they're funding based on security. One, it might be security for you have a secured market. Two, it might be the security because you have assets to back the funding. They know if they lose their money in your business, then there is a security for them. They can recover it. And the other security that they're looking for is the comfort to say you have the exposure, the experience for you to be able to look after the money that they give you. Okay, now, that being said, I think I've laid out the structural, the economic structure of our country. Yes, I took two extreme examples, but I just wanted to put it in perspective, even when we delved into detail in terms of the technicalities of raising funding. Okay, now I'll start with the first movie, which is the McDonald's, the founder. Okay, there's a clip for those who are in class. They'll be watching this clip, which shows how the McDonald's brothers raised their initial capital to start the McDonald's. But for the online, I'll just explain the scenario, and I'll just take you through the scenario so that you also can follow if you are online. So the McDonald's brothers, first they bootstrapped their businesses. So they were working in the movie. There was a recession at the time. Then they had to look at options because they lost their jobs. And then what they found is that there was one guy who was making money in that recession. It was a person who was selling food. He had a burger stand. So they saw that even in recession, people still to eat, right? So now they took their savings, they put it to buy a burger stand. Okay, so that's how they started. And that is what in funding terms is called bootstrapping. So they bootstrap from their savings, they use that to buy a burger stand, and then they started operating, and that's how the McDonald's started. But obviously it was not the McDonald's system as we know it today. It was just a normal burger stand where they're selling chips and burgers. But obviously it has evolved since then because they had to redesign the system, how it works. But they started with their savings, which is one type of funding that you can consider as an entrepreneur to tap into your savings. Then you set up your small shop or your small business, and then as you grow, then you can source other fundings. So that's how the McDonald's brothers started. And then enters Ray. After Ray Kroc met the McDonald's brothers, he used his bond. So he had a house which had equity in it. Then to start his first franchise, he tapped into that equity from the bond, from his personal house. So now in that case, he used his house as collateral for him to raise money for his first store. That's after he agreed with the McDonald's brothers to start franchising. So he had to open his store as a show to be able to show people that this is how the store will operate and all that. So he used the bond. So, and then which means the bank funded Ray to start his first franchise, but they didn't give him money directly into the business. They gave him money on the back of his house. Okay, that's now the second type of funding where you tap into the banking system, but you're not using the business as the applicant. You apply as an individual, like Ray Kroc did to set up his first business. Then fast forward, obviously, and Ray had disputes with the McDonald's brothers, and they decided to buy them out for $2.3 million at the time. But he didn't have enough funding in the business to buy the brothers out. Then enters what they call venture capital or the banks. Sometimes they do acquisition, but the general term that is used in the industry is venture capital. So he approached the banks to say, I need to buy these people out. I need 2.3 million. Here's the business. This is how it operates. This is the cash flow. This is how it's performing. Will you be able to lend me money on the back of the business? Now, in the McDonald's, that's the first pure business funding that Ray was able to raise. And it had conditions where they say the McDonald's brothers wanted to the 1% of the net profit into perpetuity, and then the venture capitalists or the banks who funded the transaction, they said no, they are not willing to do that, and that's why the 1% was never in the contract, and McDonald's brothers ended up losing on the 1% that they wanted of the royalties in perpetuity. So, but that's the third type of funding within the McDonald's scenario. First, it was bootstrapping, where the McDonald's brothers used their own money, their savings, to start the McDonald's shop or burger stand. And then enter Ray. Ray used his bond or his property to raise money to set up his own franchise store. And then when Ray was buying out the McDonald's brothers, he now used a business funding, as we're going to discuss it today. Because why was that a business funding? Is because the bank was looking at the cash flow of the operations. At the time, they had few franchises. So the bankers assessed Ray's application based on the cash flow of the business. That's now a business loan. That's how he bought out the McDonald's brothers. So now we already discussed in terms of from the founder movie or the McDonald's case study that there are three type of funding that we use in the process. Obviously, there will be others where they get overdraft facilities and all that. But these are the key finance options that the McDonald's movie or the McDonald's case study indicated in the. We're gonna watch a clip from the founder where it shows how the McDonald's was funded. So it starts with the McDonald's brothers, how they funded their first store, and then how Ray funded his first store, and how Ray funded the acquisition of the McDonald's brand as a whole. So the first one is the McDonald's brothers. They bootstrapped their business, and then Ray used their bank loan through the property or through the bond to fund his first McDonald's, and he used the venture capital to fund the acquisition of the McDonald's brand. Enjoy the video. Moneyball is a little bit different. They didn't raise the funding, but they funded it from the internal resources, which is called equity funding. So the business was operating, and when they're expanding or buying new players, they used the resources that have been generated internally. So now we're going to watch the video where Billy's asking money from Steve to buy players. So that is called funding the business from internal resources. So we're using the equity or the retained earnings or the profit that the business is generating to fund the expansion or to buy new equipment. Then enjoy this video. We'll discuss it after. As we have seen from the clip, Billy is asking Steve to give him money to buy players. So Steve indicated that they don't have the money to buy players, which now is forcing Billy to fund the buying of the players from the income that is required, that is generated from the business. So if Steve had funded Billy, it will be a shareholder now. It will be a shareholder funding. But because Steve indicated that there are no funds, then Billy had to use what you call the retained earnings within the business to buy players, which is actually the ideal way to fund the business. The business must finance itself. So Billy used the Auckland A cash reserves or the retained earnings to fund the business. Generally, how business use it is a certain portion is kept. Once the business is making profit, a certain portion is kept in the business to fund the expansion. And then the certain part is given to shareholders as dividends. So as a business, you must have a policy in terms of how you pay dividends. You can, I guess, pay 100% of the profit that you make back to the shareholders. But ideally, there must be money that gets reinvested in the business for expansion so that you don't go outside to raise money. You are using the internal resources to fund your business. So sometimes they say, generally, it will be 50% of the profit that the business has generated. It stays in the business to expand, to do new project that needs to be done. And the 50% gets paid to entrepreneurs or to the shareholders. But depending if you are funded or not. If you are funded, obviously the funder will put the restriction on how much money you can distribute because they will want to be paid first. So, but if you only have equity investment, meaning investment from shareholders, then you will be able to decide on your dividend, they call it dividend policy, to say, you decide to say how much of the business profit am I paying out to shareholders and how much of the dividends of the retained earnings am I keeping in the business so that I can fund the expansion of the business. So the Auckland A's, they used the internal resources, that 50%. I don't know what was their policy in terms of retention of the retained earnings, but they use the money that they've generated internally to buy new players. And they use the money that they received from selling players to buy new players. So it's internally generated funding. They didn't go outside to look for funding, but they used the resources that they have within the organization to expand funding, to expand the business, which is another way of funding your business, funding it from your own equity. Instead of going out, requesting funding, doing funding application, the money that you generate, instead of paying out or enjoying it as dividends as a shareholder, you retain certain amount so that you can expand your business, or you can buy whatever that you want, or you can execute contracts that you want to execute. So that's it's important to have a proper dividend policy within. Doesn't matter how small you are. Doesn't matter if you are paying dividends now or not, or you are making losses now. But it must be a policy that you set that will always remind you, even when you turn profit, that certain amount must be reinvested in the business for expansion. That's one way of funding your business expansion or your business growth. Going to the WarDog case study. With WarDogs, because it's a tenderpreneur type of business, it didn't require a lot of capital. Because you obviously is to buy equipment and computers so that you can search and be able to send your tender documentation. But the main thing comes when you get a tender. You need to be funded. So with WarDogs, they found what we call angel investor. The guy called Ralph. Ralph is the one who was funding Ephraim in AEY to buy whatever that he needed after he had secured a contract. So a tender business doesn't require a lot of funding because you only require the funding when you need to execute. So it's a low cost, a low capital based business. But the method of funding that Ephraim used was that of angel investor. He found Ralph. Ralph was a businessman in the area. He owned dry cleans, and then he approached him to say, "I have this venture. Can you invest in my business for a profit share?" So angel investors, sometimes their returns might be high, or they might want equity in your business if you're funding your business through angel investors. Here's the video for Word Docs. Enjoy it, then we'll discuss it further after. Enjoy. You've seen from the clip, Ralph is very happy when Ephraim or AEY is generating the profit that they agreed on. As an angel investor, he's not operationally involved in the business. Yes, he can come in as an advisor here and there, but he's not operationally involved in the business. Ephraim runs the business, and from the profit that are generated, then he shares the profit with Ralph. So even with the other angel investors, sometimes they might want equity in your business, or they might even want to sit as an advisor or on the advisory board. But generally, they are not involved in the business. They give you the money. Normally, these people are the rich people or business people who have money to invest in SMMEs. And I know in South Africa we have limited of those people. Or I've been in the funding space, but I haven't met many of those. But these are rich people or people with money who are willing to invest in small businesses. So you pitch to them, you tell them the business concept. If they like it, they put in money. You agree on the terms of their return. It might be shareholding. It must be a percentage share in the profit. Like Ralph in Word Docs, he wanted profit share. So that's how he was getting repaid from the loan that he had put in the business. So angel investors are one of the options that you can use. But in Moneyball, they use their internal reserve to fund the business. And then in the founder, initially they bootstrap, they use their own money to start the McDonald's brothers. Ray used a bonding his personal home to set up his first franchise. And later on, when he's buying the McDonald's brothers, he used what you call the venture capital money to buy out the brothers. And you still have other funding options, like in Word Docs. Because it's a tender, you have secured the contract. Then that makes it easy for someone to fund you once you have secured the contract. So what you can do is that once you secure the contract, you approach a funding institution with the contract and say, "I want to execute this contract. Can you give me a bank loan?" Then you don't have the hassle to prove the market, because the contract on its own, it proves the market for you. They know that by you just executing this contract, then they will be paid. And in that type of funding, but they take sessions. So they'll say, we take a session of your payment, and then you enter into a session agreement where your customer will pay into an agreed bank account, and the funder takes their money and they give you the profit that is generated from there. So that's how as well you can fund your contract. If you landed a tender or a contract, you can fund it through angel investors, or you can fund it through approaching a bank to say, "I have this contract, can you please fund me?" Then you have already proven the market. And the other one is pure bank loan, where you develop a business plan, you prepare your statutory requirement, company registration, your tax clearances, and all your compliance documents, and all the ID copies of the directors and their proof of res and the proof of res of the company. the bank statement for the last 6 months or so, depending on the funding institution that you're looking for. They might also want the bank statement of the directors of the company. And then you give them the quotations as well of the funding that you need. You can't thumbsuck the amount that you need. The money that you need when you apply for funding, it must be supported by quotations. If not quotations, but an expert opinion to make sure that the funding that you need is sufficient to cover what you want to buy. Because if you thumbsuck, then you put in the funder at risk. So, and then once you have those documentation, then you submit to whichever funding institution that you find it relevant or you comply with their mandates. We'll go into the mandates of different funding institutions a little bit later, but now I'll just explain the process of you applying. Some they have application forms, some they don't. So you fill in the application form, you submit with those documents that we mentioned, the business plan, all the figure documents, quotations, contracts that you have. You submit, they assess it, and if the risk is acceptable based on their standards, then they give you what is called a business loan. Sometimes the business loan can be split into a capital loan. Capital loan is when the business is being funded to buy capital equipment, like physical equipment. And the working capital is to fund the operation, like when you want to buy stock, pay salaries, pay the operational cost, is called working capital loan. And sometimes, but for small businesses, this doesn't happen often. Sometimes a funder might want to take equity in your business. Then that's equity funding. So what happens is you apply for loan, they say, no, your business is so good, whatever. We believe in the long-term prospect of this business. Instead of giving you a pure loan that you're going to repay over a period of time, they give you what is called blended. They take equity, and then the other portion becomes equity where they have shareholding in your business, and then the other one becomes a loan that needs to be repaid. So that's one of the funding options that you can get. And as well, sometimes you get grant funding, like DTI. They sometimes offer grant funding, or your NYDA. You get a grant funding where you don't have to repay it. It's a one type of funding that you might get out there in the market. It's given you a global picture of the funding space, how it works, and there's certain things that you need to do or how you can approach your different funding options. Now, coming back to the first specific outcome is you need to determine what is your capital requirement. You need to look at your business and to see what funding or how much funding will you need for you to set up your venture. So what you're going to do is you need to look at the targeted market, how big you want to target the market. If it's the whole of South Africa, if you're targeting the whole of South Africa, then you look at the equipment that you might need for you to be able to service the whole country. So you look at the equipment, you get quotations. You look at options, getting different quotations. Normally, the Chinese quotations are cheaper, but European and the US quotations are a little bit more expensive. And then sometimes they say, most of the time, they say the Chinese equipment are less reliable. So you must look at your options. Get as many quotations as you can. Capital equipment, you get the quotations of the equipment that you need. And then there will be working capital, of course. Remember, the equipment are not going to work themselves. They're going to need stock to be able to process. There are people who will have to operate those equipment. There is selling costs. You need to package whatever you're selling. Even if it's service, you need to package it and deliver it. It needs to be delivered. Those are the costs. You probably need premises where you need to, if you're not building. If you're building, then your funding, that funding for the building will form part of your capital capex, capital expenditure. And then the working capital will be consumables, the ones that you will pay before you generate income. Remember, when you raise funding, once you buy the equipment, you're not going to necessarily get the money next month. You still have to produce the goods that you need to sell. You still have to sell them. You might have terms with your customers, 30 days. So from buying the equipment to you getting your first revenue in, it might take, depending on the business that you have, but it might take you 6 months. So you need to make sure that when you apply for funding, you know how long it's going to take you to receive your first revenue. So once you determine that, then that will tell you how much you need in funding for you to carry on operating before you get your first revenue back. So when you're looking at the funding, it's important as an entrepreneur, you need to know how much you need. And how much you need is not only on the capital equipment, it's also on the working capital. To say, for me to operate before I generate my first revenue, I need 6 months. And I know, being in this, having been in the space, you underestimate how long it's going to take you before you generate sufficient revenue to cover your operational cost. Always, entrepreneur. But it's the nature of an entrepreneur. You're always optimistic. So make sure that you do your research, you give yourself a buffer. If you thought you're going to generate your income in 3 months, then when you're doing the projections and applying for funding, apply for 6 months. If you thought it was 6 months, just double it. Apply for a year to make sure that you have sufficient working capital to carry on until you generate enough revenue or enough profit to sustain the business. That's one from this outcome, to make sure that you know how much you need. And it's not a thumb suck, people, is based on research, based on quotation, based on type of business that you are in. One, in terms of, you need to know your capital requirement. And again, it's nice to say, I want this, I want that, I want this equipment, I want this equipment. Remember, with the funding, there's this thing that's called a capital structure. Funding institution, okay, they'll tell you that they are funding based on viability. But I can tell you now, they're lying to you. There are certain things that they also look at. They're looking at the structure. Sometimes the structure, when they're talking about the structure, is how much debt can you load into this business? Obviously, if a business is 100% funded based on debt, it's got high risk of failing because debt needs to be repaid. Debt attracts interest that needs to be repaid. So those type of business that are fully funded on debt, the structure will be 100% if you are fully funded on debt. Then there's an equity portion. Equity means it's not a debt. It's not what obviously you need to pay back to the shareholders, but it doesn't have strict terms like the debt will have. So the equity part is when shareholders put skin in the game. But without putting the skin in the game, the funders will be cautious because you have nothing to lose. If your business is 100% funded by debt, if you lose the business, or if the business goes under, you have nothing to lose. So you can relax because you have nothing to lose. But if you have put something down in the business, then the funders are also getting comfortable to say, this person has put something in. If the business goes under, he will also, or she will have something to lose. So that's what the structure is. The structure is the loan part and how much the shareholders put in the business. So be careful on how much you need, because when you apply, they'll ask you how much are you putting in. And the ballpark, okay, depending. Sometimes they say for the youth or for women, they reduce the capital structure. But generally, between 30% and 40% of the funding, it needs to come from the entrepreneur. That's a good structure. A good structure is when you have about state, okay, it depends on the business that you're operating, but between 30 and 40% equity. That means money coming from you as an entrepreneur or as a shareholder, and 60% coming from the funding institution. Then it will make it easier for funders to fund you if you are putting something as significant as 30 to 40% into the business. So you need to know, you don't just daydream and say, I want this equipment, I want that, and then when you apply, you get rejected and you get upset. Apply your mind, know that you need to put skin in the game, and it must be significant percentage of the funding that you need. But that is in addition of other things that they're looking at. Like, do you have market for your product? You need to have secured market. Technically, can you operate? Can you execute this project that you're talking about? That's one thing. Do you have human resources to execute the project? That's one. Are you compliant? Do you have all the compliant documents with you? That's another thing that they're looking at. But structure, it also play an important role. I've been in the space of rejected so many applications based on the structure. To say the structure doesn't work. The structure doesn't work. But sometimes entrepreneurs don't even understand before they approach us for funding. So it's important. They can tell you that they're funding based on viability, but there are a lot of things that they're looking at. The other thing, because the structure also affects the viability. It doesn't only give them security, it affects the viability. Then, if you don't have money to put in, then they'll look at what security can you put in so that their money is safe. So if you can give them the security of up to 40% of the funding that you're looking for, that as well will go a long way into making sure that your application process is not as painful as they generally are. But applying for funding is painful. There are a lot of requirements that you need to comply with. As I said, that when you're looking for funding, you need to make sure that you know how much you need. It's accurately determined. You are using accurately reliable quotations, which are, when you apply, they say it must not be older than 30 days. That's one of the requirements. To say, you must have recent quotations. And remember as well, you have pre-opening costs. You might be looking at the working capital post-opening, but you have pre-opening costs that you need to incur. There's some compliance things that you need to do. There's some legislation that you need to comply with. You need to make sure that the office is ready. You need to show there are certain things that you pay for. Those are called pre-opening costs. And because of sometimes entrepreneurs underestimate those costs, you end up being in trouble before you even begin. We'll still, as well, I'll give you an example on the founder. Ray underestimated how much it will cost him to set up his first McDonald's. One. Secondly, he underestimated the costs that were required for him to operate a franchise. And he was in trouble. Lucky enough, he met Harry, who came up with a strategy for them to use the real estate to fund the business going forward. But Ray was in trouble because he had underestimated his operating cost. So don't underestimate your operating cost, because they were charging 9% royalty, but the 9% royalty was not enough for him to run the operation, to monitor the franchisees, to make sure the franchisees are compliant, to make sure that the system is working the way it's supposed to. By the time he realized that, lucky enough, he met Harry Sonnebom, who advised in terms of to say, McDonald's is not a burger business, it's a real estate business. You need to own the land. And the land was giving them upfront capital. So that helped them a lot. But the mistake that Ray Kroc had made at the initial stage, it was the operational cost. He underestimated it, and then he realized once he had started that he had under budgeted for his operational cost. And then, lucky enough, as I said, Harry came through and then helped him with to make McDonald's the real estate. So make sure that when you need funding, even if you're not applying for funding, even for your own, even if you are putting money on your own, make sure that you know how much it's going to take, because you will be bonded to the brim and realize that you still need more funding for you to execute your project. And there's nothing dangerous like running short of money. Just to recap, Here's the clip to summarize today's lesson.
Funding required. Where possible, bootstrap your operation. Bring discipline to spending both capital and operational. If you are a startup, start your organization from your own without relying on external funding. And if you're already started, grow your business as much as you can before you seek external funding. Start where you are with what you have. Otherwise, you may not start. As a country, our financial system is not very efficient when it comes to funding entrepreneurs, and it is discriminatory. Based on our experience, our financial system discriminates based on color, gender, and locations. If you're black, you will struggle to find funding. 1. Your immediate network is poor. 2. Financial institutes see you as a high risk. Our systems prefer males over females and prefer urban over rural. Enough about politics. The message is that you should start where you are with what you have. The system will not change in your lifetime. Liabilities. Liabilities are basically money that the business borrows. Where possible, bootstrap your operation. Start by funding your business from your own pocket. Start where you are with what you have. Otherwise, you may not start. Liabilities can be used to accelerate organization growth and can also be a drag, where high liabilities destroy potential value that can be created. Liabilities are not patient compared to equity, which is patient.
Ray started McDonald's using his equity in his property. The banking system found it easier to advance personal debt than business debt. Ray Kroc took personal risk by using his property to raise the funds for his first store external funding. He later found a creative way to expand, of course with the help of Harry Sonneborn. It is easier for inventors and banks to support an already operating business that seeks to expand its operations.
EY was fortunate to have Ralph to provide equity funding. Once they got the startup funding, it was easier to get expansionary funds. Startup funding is the most difficult funding to raise. If you have a rich associate, uncle, or any other family member, you should consider approaching them. You have a better chance of securing funding from them than our funding institutions, more especially for startups. Find a creative way to start without external business funding, otherwise you'll never start.
The A's self-funded their operations. The owner insisted on operating within their budget, regardless of what competitors were doing. He just refused to spend the money that the team didn't have. Lack of easy money forced Billy to find creative ways to win with the limited budget. How can you start your business without resorting to external funding? Entrepreneurs should explore creative ways to bootstrap their businesses. Find a way to set up and operate their business without external funding. Complete the assignment. Compare how the topic is addressed in the three movies and rank them according to your preference on how the characters and the organizations dealt with the topic and motivate your ranking, 1 being the best and 3 the worst. Analyze this topic and its applicability to your situation and industry. Write up your analysis to meet the requirement of the industry you're operating in. Update the relevant section in your business plan.
Okay, and remember, each business is different. What we're going through now in terms of this lesson is just the generic approach. Obviously, each business will be different, and the funding requirements will be different from one business to another. So look at your situation and take what we're saying to heart and understand that what is required, because it's important for you to analyze your business, do proper research, and do a proper business plan. So when you're raising funding, you talked about the business plan that is required. And sometimes it's not easy to develop the business plan, because when you develop a business plan, you need to have financial projections that you develop. And the financial projections are the ones that are going to determine the funding that the business needs going forward. So to do that, currently there are certain institutions that are doing it, but at Super Dealmaker, we've developed an application, an app, which is currently a desktop app, that automatically generates a business plan within minutes. This is the app that you can use to develop your business plan so that you can see how much funding you need, because it automatically generates your cash flow and it will show you the funding that you need, and it's professionally developed. You can use it to submit to different funding institutions that you want to apply funding to. So try the Super Dealmaker one if you want to develop a business plan, but generally you can approach your CEDA, your NYDA if you are youth. They have vouchers which they can appoint a consultant on your behalf to develop a business plan for you. But if you have the experience and the exposure, business plans are easy to develop. You can also use our app, or you can just Google and find out how the business plan is done. Do your financial projections. Make sure that the funding that is required is from what you have in your mind and what is on the business plan are the same. Because the funders are guided by your business plan. Unless if it's a contract, the contract is different. You might not need a business plan. You just need to do the costing of that contract, ensure that you'll be able to execute. But if it's a business, you need to do a full business plan, which will make sure that you account for everything that you will need when you are operational. And that business, from that business plan, there will be your financials. Your financials is your income statement, balance sheet, your cash flow, and statement of changes in equity. Those are the four main financials that the funders are looking at or they're looking for when you are applying for funding. And you must have projections. So you must have actuals. If you are an existing business, you must have actual financials, which are historical financials. And then you must develop your projections going forward in terms of how much you believe you'll be able to generate. And based on that, the funding institution will look at your application, look at your business plan, look at your financial projections, and assess the viability of your business. That's how they do the assessment. But if you want to try a business plan, try Super Deal Maker. You can generate that business plan in minutes. Okay, now we're getting into our second specific outcome, which is you need to be able to, as an entrepreneur, you need to be able to compare the different funding options. So what we'll do now, we'll go into different funding options that you have and institutions that you can approach, and then identify and just high level mandate so that you know which institution might be suitable for you and your venture. All right. So, and then, okay, we're not gonna dwell much on the bank. Okay, the banking side, we'll just do them as a group. All the banks, they look for the same thing. The most important thing is for the bank, for them to fund you. The banks will look at, one, your credit profile. Do you pay your creditors? Do you have a good repayment record? That's one. Secondly, do you have security for the funding that you're looking for? So one security might be the collateral. Do you have an asset that can, in case of you default, asset that they can use to recover the funding that you're looking for? And three, they're looking at the viability of the business on its own. So is your business venture viable? And remember, the banks, they hardly do startups. They might claim they do startups, but really they don't. That's just for marketing purposes. They don't do startups. What they do is existing businesses. They want to see your bank statement. They want to see your banking. They want to see the cash flow that goes into your business so that they can assess if the activities that you are doing justifies them giving you a loan. So that those are the main three things that our banking institutions are looking at. And that now it's a problem because the banking institutions are the main ones who have the infrastructure to reach everyone in the country. They are closer to the people. But the assessment process is so strict that generally entrepreneurs will not be funded. They are hardly funded by the banks. Actually, the banks are funding people who really don't need funding. You must have security. You must have serious cash flow. You must, in terms of the banking, you must to be banking and be able to prove that you have the activities that support the funding that you need. And then you must be having a viable business, which it's hardly and it's not geared for SMMEs. More especially black-owned SMMEs, because one, as I said at the beginning of they don't have security. Most of the time. Two, the cash flow. Sometimes you are a startup. You can't prove your cash flow. You are unbanked. You can't prove that you have the cash flow that they are looking for. Three, the market. You don't have secured market. You're hustling, you're out there trying to make things happen. When you approach the bank, they'll want proven market. You don't have an uncle that you can call who can give you letter of intent or can give you contracts. So the way our banking system is designed, it's not designed to support the SMME sector. And in addition, you'll see that even if government tries to bring them in, to show how unready or unwilling our banking system is in funding SMMEs. The government, during the COVID-19, our government gave the banks 200 billion to fund SMMEs that face challenges during the COVID. I can tell you, okay, the funding was issued in 2020, but up to 2021, where we are now, I think in 2021, May, that's the last report that I saw, they only funded 10 billion rand. Out of 200 billion that government made available. It was not the bank's money, it was government money. But because of unwillingness of the banks to fund SMMEs, because most SMMEs that the government had in mind, obviously were black SMMEs. But because of unwillingness, I don't think, because in terms of that funding, the government was guaranteeing, I think, 90% of the loan. If there's a default, 90% of that loan will be used from that fund, and then the bank only takes 10% or so on that loan, the risk that they're taking. So if you look at it, the banks were not taking risk. Government was saying, since you have the infrastructure, here's the funding. Please make it available to our people. But because of the system, the way it's designed to discriminate against SMMEs, the system couldn't fund those SMMEs. The money is sitting there. Probably, let's say now they have 180 billion that is sitting, that they were just not willing to fund SMMEs. And their excuse is they don't have SMMEs to fund. And we know practically, I mean, that's nonsense, because we know how COVID affected the SMME market. They're struggling. The SMME market is bleeding. So for the banks to claim that there are no SMMEs to fund, it's just uncalled for. So, but as I said, I don't necessarily blame them, because the system that we have, our financial system, is not designed to support SMMEs. Because as we're going through, I was listing things that are required. You need to have collateral, security. Most SMMEs, they don't have security because they don't own land. They're staying at, where they're staying is PTO, permission to occupy, from the traditional council. And our banking system doesn't accept that. Sometimes most of the time, when you're running an SMME, you have challenges with your repayment. So your credit score, even if you are not listed, your credit score will not look good, because you are in business, you are not earning a salary. Yes, a person who's earning a salary, you expect them to, because they know how much they can expect every month, you expect them to be able to maintain their credit score. But if you're an entrepreneur, sometimes deals come, sometimes they don't, business bad. So for you to maintain high credit scoring, it's close to impossible unless you're doing well. So those are the challenges that our banking system are looking at. And then, as well as the background, they look at, I mean, if you're black, chances are you are high risk, because you don't have experience in business. So unlike if you are white with an exposure, it's easier to fund you, because you're comfortable. They will be comfortable with you based on the experience. But it's not only, it's the system itself. It's not individuals that are, I'm calling racist in a way. The system is racist. I've been in that space. For me, obviously, you have self-interest. When I was working in that space, if I have a black application and a white application, I will tend to favor a white application because of self-interest. Believe me, I'm as African as they come. I'm Pan-Africanist. I'm Steve Biko and all. But when it comes to, it's my job. So if I have a black application and a white application, I will favor the white application because one, it's easier to motivate a black application to my bosses. That's one. It makes my life easier rather than trying to motivate women, youth in rural area. They'll ask so many questions that they'll short of asking me for this person's DNA. So for me to avoid going through that process, that travel, they make it easier for me to motivate a white application because they will even motivate the committee that you're submitting to. They will even motivate on behalf of the client to tell you good things about the client because the application will be white. Because yes, historically they have advantage, they have exposure. One, two, they have securities that they can give you. Three, they have a market because they have networks that they will be able to give them secured market. So even for me, it made it easier for me to motivate in a white application. That's one. And then in terms of performance, because of the background of black people, we are not exposed to business. So chances of running that business into trouble are high than a white person who has been exposed. So for me, I don't want to have a portfolio of failed businesses. As much as I want to develop and I'm black Africans, but ultimately my bonus, my performance was based on the performance of my portfolio. So I'd rather have a performing portfolio than being pushing the empowerment agenda. That's the self-interest. So the system is designed in that way that it's not easy for a black application to be successful. Even when government put in that 200 billion, it gave it to the banking system to lend to the businesses that were affected by COVID. Still, because the system is designed that way, self-interest comes first. For the employees, you don't have to be a white employee, even if you're a black employee. You have self-interest to make sure that you perform. And then when you submit, you don't want troubles where the committee is grilling you. So what you will do, you will automatically comply, submit, prefer white applications. Hence, they couldn't disperse the 200 billion that the government made available for them. And just to make it practical, with RMKs in training. So when the COVID hit, we were affected by COVID. I had contracts that were cancelled. And I fully complied with the requirement from the government in terms of that COVID relief that they gave to bank. I approached my prestigious bank and my application were rejected. And the reason that we're given is that we can see you comply. We can see the business that you lost because of COVID. And you were in good standing with us because that's one of the reasons that we were required. You need to be in good standing. And I had said to them, look, I have equity in my property. I can give you security. I mean, you are secured. The money that I needed, the equity that I had in my property was four times more than what I required. But what they said that your credit record, your repayment record are not consistent. So we can't fund you. Despite the fact that there is a security, there is 90% that is secured by government. I have 4 times secured amount I have 4 times value to secure that amount that I was looking for. They still rejected my application. That's the practical assessment. That's the reality. And believe me, I'm a professional. Imagine what's going to happen to that poor young woman from a rural area who's affected by COVID, doesn't have security, one. So, and then maybe the banking profile, his repayments are not as good. What are the chances of them funding individuals like that? So those are the challenges that are there in our financial system. Yes, we have options where you have DFIs, which are development funding institutions, which are owned by government. So now I was just addressing the challenges that we have the banking system, but that system is not geared for funding entrepreneurs. It's not geared to funding SMMEs. And then on the other side, we have the GFIs. Now, coming to the GFIs, obviously, we have different GFIs that have different mandates. I'll start with GBSA. GBSA is not necessarily for SMMEs, but it's funding big infrastructure projects. So GBSA is for infrastructure. That is their mandate. It's understandable. It's not to fund SMMEs. Then we have DTI. DTI is to develop industries. So there are grants there that needs to be funded to different entrepreneurs. There are different schemes that they are running there. So if you have something innovative or some special scheme, you go into their website, you check their schemes that they are running. It's called into the Department of Trade and Industry. You go into the website, you check different schemes. If you meet the requirement, you apply there. So generally, DTI gives grants. It's not loan. They're not necessarily business loans, but they are grants. And grants are another form of business funding. But sometimes our entrepreneurs are so used to grants that when you apply, you don't apply with a viable business because you're applying for a grant. You don't have sustainability in mind. You get used to grants to say, even if I deplete the money, I'll get the grants. So I'm not a big fan of the grants. Don't get me wrong, I believe in making funding accessible, but giving businesses grants, it creates a different culture of entitlement. Should be blended loan or soft loan, if you want to call it soft loan, with easy repayments. But the entrepreneurs or the business people, they must know in their minds that they need to repay the loan or the investment. We must always make sure that we wire our entrepreneurs correctly. But I'm not saying GTI must not have grants. It's just that I'm not a big fan. It must rather be more soft loans than grants. And then we have CIFA, which is a small enterprise finance agency. They are funding from I think 50,000. I think generally it's to 5 million, but I think they can go up to 15 million if it's a property deal or something. So CIFA, it's bang on SMMEs. It's a government agency that is set up to fund SMMEs. SMMEs. So the challenge, yes, it does fund, but the challenge is now you're still facing challenges with CIFA. Their portfolio is not sustainable. They have about 60% bad debts in their book. The SMMEs that they are funding is the bad book. But it's a developmental institution, so you expect them to write bad deals. But if you're looking for funding of between 50,000 and 5 million, of if it's a property deal or a special deal, up to 15 million, you can approach CIFA. It's a government owned. They have offices in all the regions, but still, it's got its own challenges in terms of speed. If you have a contract for them to process your application, it takes them more than 3 months, which is it's a long time. By the time the funding gets approved, probably your term to execute the contracts will be done. And secondly, maybe my challenges with CIFA, it doesn't as well. It has moved away. It doesn't fund startups. Okay, they do. It's within their mandate to fund startups. But if you put the startup application through, you're unlikely to be funded, even if it's a government institution. They prefer franchises because there's a system and there's a white. Normally, franchises are owned by white people. So there's that mentality that you fund, they feel comfortable funding franchises because they have trusted system. But they also high risk. They're burning their fingers on that. They still have a bad book of. The next funding institution that you can approach for funding is IDC, Industrial Development Corporation. IDC funds mainly industrial or manufacturing businesses. But they also have services where they fund tourism and they fund movie making. And those are some of the few services that they fund, and technology. But mainly, their focus and their mandate is industrial development, basically funding industries, which are mainly manufacturing and production and farming. And as well in farming, they don't fund primary agriculture, they fund processing, which makes it industrial. So that's IDC. And also the requirements are similar to the requirements that are needed by other funding institutions, which is mainly the business plan, the FICA compliance documents, and proof of market, proof of contribution, bank statements, and proof of financial records of the business. Their funding starts at 1 million up to 1 billion rand. So if you need 1 million up to 1 billion, IDC is the institution that you should approach, but you must check the sector that you are in to see if you are within their mandate. And IDC's got a very long history in terms of developing the country. It's one of the institutions that funded the likes of Fosco, which is a phosphate manufacturing business in Limpopo, which is massive. And then they funded institutions like your ISCO to build ISCO. And mainly what they're looking for is obviously the market. You must have the market, the technical know-how, and the structure. It's important when they look at the funding transactions, where the structure, I mean the proportion between the loan and the equity contribution from the entrepreneur. And the sweet spot in terms of the equity contribution is between 30 and 40%. So equity contribution, the entrepreneur or the shareholders must put in 40% or 30 to 40% equity, and IDC will fund 60% of that funding to make it 100%. Look, there are exceptions and there are different transactions are looked differently, but that's more or less their funding criteria. Yes, they'll tell you that they're funding based on viability, but structure becomes important. Structure is important because it will lead to a business being viable or not. Highly, as I said earlier, highly geared, meaning businesses with high debt, they are susceptible to failure because debt you need to repay, there's interest that you need to pay, which increases the cost of operating a business. So that's IDC. And they also have regional offices that are based in Sandton, and they have regional offices in each province. So if you are in the industrial space, manufacturing space, agro processing, you are doing movie or media, you are in media, or you are in tourism, then IDC, it might be your fund of choice in terms of that. But you need to look at how much you need, if it's above R1 million and below R1 billion, and look at your own contribution, which is their sweet spot is between 30 and 40%. So that's Industrial Development Corporation. And now we're going to the next one is National Empowerment Fund, which now is mainly focused on triple BEE transactions. NEF funds from 250 to about 75 million rand, and mainly the focus is in funding majority black-owned businesses. So if it's 51% owned black business, NEF will look at that transaction, and their criteria is similar to CIFA and IDC. The only difference is they are very, in terms of, but that's the mandate. They are very strict on the triple BEE, and the challenge now that they're currently facing is recapitalization. Government is not recapitalizing the NEF. The reasons, I don't know, because NEF is the institution that was established to empower black people. And I think it plays a very, very important role in the economy and in the funding space, which addresses the challenges that we've addressed earlier on the banking system, that the failure of banking system on funding black entrepreneurs. So NEF was introduced to counter that, to be there as an institution that it balances the limited funding from the banking, the private banking institutions. Then NEF was supposed to play in that space. But why they're not recapitalizing it, it's baffling me. But probably it's because of, I think it's political, because the CEO, Ms. Mtetwa, had a fight with the DTI. So he had a fight with Rob Davies at DTI, which DTI is the founding, what do you call it, a shareholder in NEF. DTI is the one that's supposed to recapitalize NEF. Because of those political differences, black businesses are suffering because NEF doesn't have fund to support that BE initiative. But they're working around it. I know they're doing enterprise development. They're trying to be big in funding enterprise development projects. Unfortunately, they're struggling financially because there's no recapitalization from government. And in terms of that recapitalization, then it takes me back, not back, but to the SME fund, which was established by corporates from the JSE. I think it's about 50 corporates from the JSE to fund SME in South Africa. It's not SMME, it's SME, their target market. And unfortunately, I don't know, I know there are government institutions like PIC which participate in that 1.45 billion to establish that fund. But to me, didn't make sense, because you have NEF, you have CIFA, that PIC could have put their own funding in instead of establishing another SME fund with white-owned companies. Because CIFA and NEF, they're driving empowerment. They are big on funding the previously disadvantaged, who are the main people who require assistance and support. So your PSC, your telecom participating there, and then you have black executive busy laughing there, putting money into that SME fund instead of putting it in your NEF or your CIFA. It was, I don't know, it was just baffling. And strategically as a country, I saw it as a flaw in terms of the direction that they took. But obviously they were buying face so that when they are fired from their government institution for non-performance or for corruption, they have an institution that will take them as the board members. That's the only thing that I could make sense of it, to say you have a government institution putting money into the SME fund instead of putting it in NEF or CIFA. So there's SME fund. It operates actually more similar to banks, where they're looking at collateral, they're looking at a secured market, they're looking at the profile of the entrepreneur, and I guess they're risk averse, and they're not doing startups. Instead of where your CIFA and NEF supposed to be doing the startups. So there's that SME fund that you can approach. And another funding institution is PIC. They have a Isibaya fund. Isibaya fund is looking at as well, like your kind of BE transaction, to make sure that they empower BE transactions, but they do any commercially viable transaction. Their funding at the time, we were starting the last time I checked, it was starting at 20 million and then up to billions, because they're quite big. They're within the Public Investment Corporation. It's just a small division, but I mean a small division with a 5 billion kitty. It's a massive. It might be small within PIC, but in terms of the funds that they have about 5%, which is that is Isibaya for you. And if you're looking for funding, there are also one option that you can look at. And the other funding institution that you can look at if you are in agriculture is the Land Bank. It's looking at mainly agricultural project from, I think they look from primary to agro processing. And the challenge that I have with Land Bank is that they're also looking for title deeds and all that. And we know that majority of South Africans, they're operating from leased land or PTO land. So in that way, they would struggle to penetrate the rural areas where our people are mostly who are suffering, who's supposed to be in agriculture are living. So the Land Bank, call it mandate, is a little bit skewed because if you're not helping people on the PTO land, then who's supposed to help them if you're a government institution and not helping such people? So, but which is it's a good institution. And the other strategically probably what is surprising me is that as an institution, it's small. It was never expanded from the apartheid era. Remember, during the apartheid era, it was established to service limited number of farmers. But now, once after the democracy, because their mandate was supposed to have been expanded, supposed to be the highly active funding institution from the government side. It's supposed to be mostly active, the most active DFI, because of farming and land is one of those activities that we're supposed to get into to make sure that we have food security. Those are the main large, call it government institutions, the DFIs as they call them. And you have specialized one like your Technology Innovation Agency, TIA, which it's a government institution, but it funds your technology innovation. Then you have your KfW, which supports developing countries from the German Development Bank. And then you have, now you also get your provincial DFIs. Each province, I think it's got its own DFI. I know it's, like your Limpopo's got your LimDev, KZN has got I forgot the name, but they have their own institution. And then as well, each province, they have their own DFI, which also they're supposed to be providing funding, but most of the time they're not capitalized. So most of their budget goes to human resources instead of going into projects. And I also feel strongly that actually the provincial DFI is supposed to be facilitating funding for the national DFIs. So it must provide locals with access to funding instead of trying to compete with your national DFIs. And then we spoke about commercial banks. And then one of the major players in SMME funding is Business Partners, which was established by Rupert. It's focused on small businesses, their funding starts from 250 million to 15 million. And they have a model which works. It's sustainable, it's a profitable funding institution, except for the banks. There are few institutions like Business Partners, which is financially sustainable. All these GFIs that I've mentioned, none of them are financially self-sustaining. So Business Partners is funding SME from 250 to 15 million, and then it's within certain franchising, all those smaller, and they're big in property as well, property development. As I've said, that it is sustainable because it's the private institution. The GFIs, even though they're not sustainable, obviously GFIs, they are established to develop the economy. Their mandate is not to be self-sustaining. One institution that was which is still, but the balance sheet is weakened now, is your IDC. Because during the apartheid era, they had built a portfolio of very good investments that they've made, where they were getting dividends that allowed them to continue operating without government support. But post apartheid, there's no major investment that's sustainable investment that they've made. Yes, they've invested in big projects, but they're not sustainable, the most of the projects that they invested in. So their sustainability and their balance sheet has taken a knock. So the self-sustaining pride that government had with IDCs coming to an end. Unlike business partners is sustaining itself from profit that it makes from its operations. But okay, the flip side to it is that business partners' rates and charges that they charge entrepreneurs is crazy. But it makes sense. With this high risk, you need to charge high rates, like we're talking 30% IRR, or okay, above 20% IRR is what they were looking at the last time I checked, which is very, very high. But given the risk that SMME present, it makes sense. If you want to be sustainable, that means your interest charges are supposed to be high. That's your business partners. It's the last one. But you have many other funding institutions. Now, with the fintech, you have your Lulamed, but those now are mainly funding contracts. So most of our fintech, in the fintech space, they are funding contracts, which you can explore. I know Lulamed, there are quite a few. Voda Finance, I can't remember the exact name, but Vodacom has got its own funding institution. So you have, as an entrepreneur, we have different funding institution and different options that you can take. And I know there are certain criticism that I've presented on different institutions, but as an entrepreneur, and based on our first lesson, that as an entrepreneur, you need to be persistent, you need to push, you need to make sure that you make a difference and you push. So with this negative comments that I've made, doesn't mean you shouldn't be applying. For you to change the system, you should be pushing. So I encourage you, if you need funding, these are some of the institutions that you might want to approach, but there are many more institutions that you can approach. So look at your business, look at your funding requirements, and do your research in terms of which funding institution is appropriate for your business. And another specific outcome that we need to make sure that we touch on based on the uni standard that we're currently doing is the documentation that are required when you're applying for funding. Okay, different institutions require different documents, but there are standard documents that most institutions need. Okay, so the first ones are your figure documents, proof of address, your tax clearance, company registration document, your personal assets and liabilities, your permits. Okay, which sometimes most businesses don't have. A permit to operate. If you are running a business, you must always, if you are not in an industrial area or a zoned area where it's zoned for the business that you are doing, you need a permit. If you are operating from home, you need to speak to either your council or your traditional councillors to give you a permit to show that they know the business exists and is approved. And in some cases, the municipality can give you that permit. You must always have a permit. And make sure that your tax affairs are in order. And make sure that you have a bank statement or bank account that is running, and you run that bank statement accordingly. And you're gonna need your directors' ID copies and proof of address, and then you might need their personal income and balance sheet, so that when you're submitting, you are submitting with all those documents. And another important one is the business plan, which is important, which shows where your business is, where is it going, your financial projections, how much you need, why you need it, and all that, and proving that you have the market. So business plan is a document to prove the viability of your business. And as I've said earlier, you can log on into Super Dealmaker. We have developed an application that automatically generates a business plan for you. With few clicks, it takes you a few minutes. but obviously you can amend it as you go. Let's watch the clip where the importance of a business plan is explained using our 3 case study movies, which is The Founder, Moneyball, and War Dogs. Enjoy the video.
The question is, why do we need a business plan? Generally, a business plan is not a must for an entrepreneur, especially if your business is self-funded. There are other schools of thought that believe that you don't need a business plan, especially if you don't need any external funding. Personally, I believe a business plan is important for the following reasons, in no order of importance. A business plan helps you identify, assess, and manage business opportunities and their related risks. It's a structured approach on how opportunities will be exploited and risks will be mitigated. It keeps the team focused on key objectives. It is used to recruit key partners, funders, key employers, suppliers, or customers. Even if you don't need funding or partners, a business plan is still an important guide for your strategic plans.
Ray Kroc and the McDonald's brothers didn't think through the financial business model and how it would be exhausted before they entered in an agreement. The brothers lost hundreds of millions from the transaction. Only after they signed the agreement, they asked, "What is next?" Mr. Kroc just told them to leave everything to him. A proper business plan would have helped to avoid the unnecessary conflicts and mitigate the risks that comes with transactions like this. Lack of planning resulted in unending conflicts, and if they had properly planned the expansion, the brothers could have financially benefited from the growth of McDonald's than they did. Ray Kroc is trying to raise additional funds without a business plan. Unfortunately, he exhausted equity in his property. A business plan is important to raise funding. If Ray Kroc had a business plan, he could have used it to source the funding.
AEY appears not to have a formal business plan. These are cowboys. They planned on the go. But it must be said they were held by an equity investor in Ralph. It gave them freedom to operate freely. Because of the simplicity of their business model, Ephraim was able to articulate the business plan clearly and was able to pitch to potential partners with ease. Their business model was to operate based on the money available. It is difficult to develop a business plan for tendering businesses, which is a general dealer, supplying anything that is required. Their business model was to throw in as many bids as possible and hope for the best. Even though AEY landed a $3 million contract, they experienced too many problems because they did not conduct proper due diligence and their execution was unstructured. At the end of the day, they failed to fully execute the contract because of the conflict between Ephraim and David. The conflict was caused by the lack of organization values and a guiding contract execution plans strategy. Ultimately, they got arrested because they did not pay the packaging guy, and this was the least reason for them to get arrested.
On the other hand, unlike AEY, but similar to McDonald's, the Auckland Aid had a complex business operation that required a comprehensive strategy with proper planning. Just note that the general terminology used for a business plan for an existing business is called strategic planning. During the meeting with the scouts, Billy had an unnecessarily difficult conversation because the scouts didn't know the play. Billy had not communicated his business plan with the scouts. This lack of communication regarding the business plan also comes through during the conversation between Billy and Coach Art. But this scene shows that Billy regretted not communicating this business strategy with the team. Billy's failure to formally develop a business plan and share it with the team caused problems with him. The team did not buy into the strategy early on, and he struggled to efficiently execute the plan. Billy's failure to communicate his business plan with the team made it difficult for the team to embrace his strategy, and this resulted in the team's adoption of the strategy taking longer than it should. Complete the assignment. Compare how the topic is addressed in the 3 movies and rank them according to your preference on how the characters and the organizations dealt with the topic and motivate your ranking, 1 being the best and 3 the worst. Analyze this topic and its applicability to your situation and industry. Write up your analysis to meet the requirement of the industry you're operating in. Update the relevant section in your business plan.
But now, a business plan sometimes becomes a gatekeeper where you are turned away or you are rejected because you don't have a business plan. And CEDA, a small enterprise development agency, it assists entrepreneurs with developing business plan. You pay about 10% of the consultant fee. And then as well as NYDA is got consultant on their database that develop a business plan for youth entrepreneurs. You can approach those two institutions to assist you develop the business plan. But with the Super Dealmaker, the application that we've developed, we're trying to commoditize the development of business plan. It's not supposed to spend, because they spend millions, this institution, developing the business plan. But with the Super Dealmaker, it makes it easier to develop a business plan at a fraction of the cost that this institution is spending. And the quality is not bad. And you know the quality will be standard. You're using Super Dealmaker to develop your business plan. That's a business plan. It's very important for you to, when you're doing the funding application. But again, don't just use the business plan for funding application. It must be a living document that you use to develop strategies, to see where you are, to monitor your business performance. It's a very important document. I know it's tedious to develop, but don't just use it for the funders. It's for your business, to make sure that you develop, and there are certain goals that you need to meet that should be in your business plan, so that you continue growing your business. Another other documents that are required is a 6 months bank statement, just to see how you're running your business, to monitor the cash flows in your business. And then your bank account must be in good standing. Then, as I mentioned, the business plan, obviously the business plan must have your cash flow forecast. And generally the forecast is 5 years. The first 2 years, they want it monthly, and the rest you can do it annual. But it depends on different institutions. But most institutions, they want you to project the first 2 years on a monthly basis, and then the next 3 years or so, or you can even project more, but the next 3 years, do it annually. So it will be 5 year projection, first 2 years monthly, and the 3 years you project annually. That's your financial projections, and you're gonna need your historical signed financial. Most of the time, they want 2 year historical, if you are not a startup. So you need to give them 2 year historical financials, and then you submit them with the pack with the things that we already mentioned above. And what they'll do as well, but this is not for you, they will do your credit score or credit checks to see how you maintain your accounts. And also, if you have collateral or security that you'll be giving them, they will want documents. If you have a freehold properties that you will be offering as security, then you need to include them in your submission. And any other information that can motivate or can support your application, you need to include it in your application. Like if you have contracts, letters of intent, off-take agreements, such thing, quotations, they need to be included in your business plan. Or not business plan, but the documents that you'll be submitting when you're applying for funding. You need to do the spade work up front, because approaching a funding institution without this document, it will just be a waste of your time, because by the time the official or the employee assesses your application, it might be 2 weeks later, and they're going to refer you back to say, give us 1, 2, 3, 4. Then you need to go back and still work on the things that you could have just worked on them up front. And if you bring complete documents, it makes it easier for the official to work on your application. So that's the documents that you need when you're submitting your business plan for funding, or when you're applying for funding. Okay, now at the beginning we spoke. Okay, we've touched on, but we didn't go through we went through in detail. But now, just to recap, to make sure that we have addressed all the funding options that you have as an entrepreneur. The first one we spoke about is the bootstrap. Bootstrapping is when you're using your own money to set up your business, where you're not going outside to look for funding. That's how the McDonald's brothers started their business. Remember when you're giving the example of the McDonald's brothers, they took their saving and they bought their burger stand. That's how they started. So that is called bootstrapping. So that is the most easier or viable option for most entrepreneurs, because you are not ready-made entrepreneur to be funded. You're still rough around the edges. So for you to perfect trade and to perfect your venture, it is best if you start by bootstrapping it, pushing it as much as you can without going out for funding. That's one. The second one, which is also easier than the others, is getting loan from friends and family. Yes, we know we don't have rich friends and family, but if you can sell your idea to your friends and family, that's another easier option to go for. But don't go to people who you know that if they fund you, they're going to take their last cent that they're dependent on to put it in your business, because your business is a high risk. Go to the people that you know they can afford. They get that liberty, they will be willing to call it taking a risk. So you can approach friends and family for a loan. The third one, you can use your credit cards. It's more or less a bootstrapping, but now you're using the funding institution's money. They give you credit cards. We know currently in our banking system, they'll rather give you credit cards and overdraft than giving you a business loan. It's a fact. That's how the system has been designed, and that's how it works. Instead of giving you funding that will empower you, they give you funding that will make sure that you are a slave to paying them forever, like your overdrafts and credit cards, because they know generally they're not used for constructive purchases. So if you have access to credit cards or overdrafts, that's what you can use to fund your business. Approach the banks for credit cards, which most of the time they easily issue. Then you use the credit cards for funding. Oh, now there's trends of crowdfunding, which hasn't taken off that much in South Africa, but is there where that crowdfunding sites, you go in, you put in if your idea is innovative, and there are different sectors, they have different crowdfunding platforms. So crowdfunding is where people with common interest, you put in your application, your idea, and when people see it, they put in as a donation or support of some kind. They put in money into that venture. Obviously, you'll have your targeted amount that you're looking for, and then you give it some time. You give it an allocated time. Let's say you want to raise it within 3 months. Then it's there. People see it. When they see or they're interested in putting in money, they put it until the end of the period. Then that's how now people are approaching capital raising or raising money for businesses. Okay, the other one is it's a bank loan, which is a difficult one to get, because you need to give collateral, which most people don't have. You need to prove the market, which sometimes is difficult to prove. You need to have a good banking history, which if you are an SMME, sometimes most SMMEs will struggle to prove that. And bank loans, as we spoke about the McDonald's, Ray Kroc used the bank loan to start his first store, but he didn't necessarily use a direct business bank loan. He used his bond. He bonded his house, and then he used that money to start his franchise. That's how Ray Kroc started his first franchise. And then we have angel investors. Angel investors are those people with money who are willing to support people with innovative ideas or people in business. So angel investors are generally people, millionaires, who are willing to help others to start their own businesses. As far as I know, we don't have a very strong angel network in South Africa. But internationally, they are there. If you Google, you'll find different networks. And you pitch to them. If they're interested, they put in money. And sometimes it's for equity or profit share, depending on the specific angel investor and their interest. This one, we saw it. That's how Ephraim in AEY funded their business. Ephraim used money from an angel investor. Ralph, who owned businesses in his city, and then he approached him to say, this is the business that I'm doing. When we get contracts, I need to buy the items that are required. Can you lend me money? Then Ralph was happy to lend Ephraim money, and then the agreement was that they will profit share. I think Ralph was getting 30% of the profit that is supposed to be getting 30% of the profit that is generated by AEY. But unfortunately, Ephraim, being the character that he is, he was not paying Ralph his fair share, because Ralph, as an angel investor, was not actively involved in the business. So you have an option of angel investor. There might be rich people in your area, or you find the angel investor network. You approach them, you pitch your idea. If they're interested, then they can fund your business. And the last one that you're going to look at is your venture capital, which is how Ray bought out the McDonald's brothers. He used a venture capital type of funding, where they gave him the 2.3 million to buy out the McDonald's brothers, and they also, with that, they acquired equity in the McDonald's as a franchise. So normally the venture capital, they give you funding, and most of the time is equity based, meaning it's not a loan. They put it as an equity, but in exchange you give them the shares in the business. Yes, there will be a valuation that needs to be done, but if you're SMME, you need funding. Sometimes the valuation is just daylight robbery, where they're getting more shares than the actual value, that because you'll be desperately needing for funding, but they also will be seeing the potential of that business. So venture capital, they want to benefit on the upside, meaning they want to benefit on the company that is growing, so that they can buy in now. Once the company grows using the money that they gave you, then they will sell their shares for profit later on. So that's how the venture capital model works. So those are the list of source of funding and the options that you have in terms of who to approach and how you approach, depending on your need. So what you need to do is look at your venture or your business. Look at the type of funding that you need. We spoke about different funders on that. And then also look at the funding instruments that you can use to fund your business. You can use equity, where you're putting in equity and shareholders are putting in money. You can use bank loan, where it's a loan that needs to be repaid. You can use the combination of the loan and the equity to fund your business. You can use angel investors to put in equity into your business for profit share. And you can, what's the other one? You can use crowdfunding sites where they give you donations. And then also there are certain grants that you can use, like DTI, as we spoke about DTI earlier, they offer grants. NYDA, which I haven't spoken about, but National Youth Development Agency, they also give grants to youth for starting their businesses. But mainly they give grants for the existing one. And you have a small business department. They also issue grants from time to time for business. So you must always be in the lookout for those grants. They issue grants for specific sectors. So you must always be in the know what's happening in the financial sector and know which institution to continuously check their programs, because sometimes you miss out because you're not checking the programs that are currently in the market, like from your DTI, from your NYDA, from your small business department. So you need to keep on checking those. There might be certain grants that are issued or advertised, and then you apply, and if you're lucky, you'll secure those. So those are the type of funders and funding instruments that you can use for your SMME. And also you need to know the regulations that regulate the funding of SMMEs or funding of businesses in general. So we have the National Credit Regulator, the NCR, which regulate the funding in terms of the interest interest rate. I think the maximum was 30%, if I'm not mistaken, per annum, because certain individuals or institutions were exploiting the small businesses, where when you get the loan, you find the loan interest is 100% of the original amount. So the NCR is there to assist small businesses to access funding, but at fair terms. It must not be crazy interest rates, like 100% or so. So the NCR, that's how it operates, is there. It's a regulator that they've put in there. But as well, the funders are using it as an excuse. The regulator has been put there to make sure that businesses or individuals can have fair access to funding. But it's got certain things that it obliges the funder to do. So at times the funders are using these regulations to deny entrepreneurs access to funding, which I believe the government, when it implemented this, the intention was to helping small businesses to access funding, to have funding options. But sometimes it's the regulations themselves, because of those tick boxes that are there, that are sometimes used against giving funding to small businesses. So at times it becomes counterproductive. But I guess sometimes you can't over-regulate. So sometimes you develop a legislation thinking you are doing it in the best interest of the country, and you get people who will always exploit that legislation. It's how it is. There's nothing. But you need to know that there's NCR. You need to know your rights as a borrower, to say there are certain things that needs to be done. There are certain rates that needs to be charged. You can't be abused as a borrower. That's one thing that you need to know. But familiarize yourself with NCR. The last topic that we're going to look at today is the problems that are faced by SMMEs in raising funding. Basically, apart from the systematic issues that we've mentioned throughout this lesson, there are certain things that makes it difficult or create challenges for entrepreneurs when they are raising funding. Okay, the first one is you have limited or inconsistent cash flow. When your business is haphazard, it's difficult for funders to assess the potential or the ability of your business to repaying its loan. So it makes it difficult if your business had inconsistent cash flow or revenue stream. That's number one. Then the second one is not using a budget. Sometimes most entrepreneurs, they just operate without budgeting properly, making sure they follow the budget, making sure that the budgets are managed. So what you need to do as an entrepreneur is to make sure that you have a budgeting system, a budgeting process that you put in place, you implement in your business. It's not going to only help you when you're raising funding. It will also help you to manage your business. You'll be able to budget, to know what to expect when. And if you know your budget, if you are not achieving it, you will be able to identify areas where you are underperforming and take corrective actions. But without budgeting, you are killing yourself as an SMME or as an entrepreneur. You need to make sure that you maintain budget so that you can track and follow the performance of your business. But it becomes very handy when you have the budgets, when you are applying for funding. It makes it easier for the funder to assess your business. They know that you budget and you maintain your budgeting system. Okay, that was the second one. And the third one is not raising enough capital, which is the biggest problem, not the biggest, but yeah, it's the major problem when it comes to funding. You find that entrepreneurs are optimistic in nature. They're very optimistic. So even when they're doing the budgeting, when they're raising capital, they have this amazing budget and projections, and they believe they're going to hit them from day one. In my life, I think I spent about 12 years funding businesses. but I've never funded the business that actually hit its own target. So that it's above, you outperform or you underperform. But most of the time it's underperforming. You're not achieving your target. No, I haven't seen it's close to impossible because remember, budget is prediction. So what happens because you are optimistic, you tend to their numbers to be too optimistic, so that when their numbers are too optimistic, they indicate that you need less funding. And once you don't achieve that necessary turnover, that optimistic turnover, then it's gonna affect your bottom line. And then if it affects your bottom line, then your business is gonna fail. Because once you start hitting, remember, if a funder gives you money, and then if you are not performing based on the targets, it's very difficult for you to go back and say, recapitalize us. But if you become conservative in your projection, then you might need more funding, you might request more funding than you need. It's better to return money to the funder than going to the funder requesting more funding. And this thing of not raising enough capital, I've seen it destroy businesses. Most businesses, like in which they were involved in land restitution, they were under budgeted for. Yes, the government buys their farms or their operations. I know, like the Zevedela Citrus, I know your Mike's Chicken. Those institutions failed because the government bought the farms from the white owners into the black hands, but they undercapitalized the businesses. So when you undercapitalize, then whoever the operator, they become a little bit desperate because you're trying to take money here, cover here, instead of being comfortable, focusing on driving the business forward. You're trying to see where you're cutting costs. And when you run a business where the focus is on cutting costs, you lose the ball, you lose the vision that we spoke about in our first lesson. Your focus now is trying to put out fire. And when you start putting out fire, then that's where the problem begins. So I've seen a lot of businesses fail because they were undercapitalized. And once you're undercapitalized, obviously you're going to underperform. And going back to the funder, when you're underperforming, to ask for more money becomes a problem. You rather ask for more money than you need, so that you know that you are covered. You're not worried about cutting costs and all that. You're worried about building your business. Most especially when you're building a new business, you need to be out there pushing products into the market. So you can't be pushing products while you don't have sufficient capital to support your expansion strategy. Okay, that was the third one. And fourth one is the opposite of what I just said. You might find that you're just taking too much debt, unnecessary debt. So on the previous one, I'm saying you need to take enough. If you need a buffer, let it be. But once you see that you are hitting the targets that you are hoping to hit, then you need to return that money as soon as possible, because you carrying the money on your balance sheet as a debt, then it will negatively affect your business. So don't carry unnecessary debt in your books. If you can settle the debt earlier, do it, because it will affect you. And then for you, when you are applying for, let's say you are in trouble, then if you don't have sufficient collateral or free assets to fund your expansion, the banks won't fund you. The TFIs won't fund you. You'll struggle to raise more capital for your expansion. So don't carry more debt than you need. But to support the previous point, you must make sure that you have sufficient capital or money to push your business. That was the first challenge that the entrepreneurs are facing, that they have too much debt and then they can't raise more debt, and then you end up being in trouble. And the fifth one is neglecting necessary reporting. I know a lot of SMEs. I'm an accountant, and I'm not practicing as an accountant because SMEs, they don't see the importance of reporting. They don't see preparing financial statements as one of the critical components of their business. And if you don't keep records, you will need them at some point. You will need them when you need funding. And I've seen that when I'm on the other side where I'm assessing application. You see, these financials were just put together to submit the application. They are not accurate. They find the cheapest accountant they can find just to comply, to say the financials are there. But when you start analyzing them, funders will have to analyze your reports closely to make sure that they make sense. When you start analyzing them, you find inaccuracies. When they're not accurate, then the credibility of that entrepreneur is starting to be questioned. You start questioning the integrity and the credibility of the entrepreneur. So you don't want to be that entrepreneur that their integrity is questioned. Make sure you keep proper records. Make sure that the records reconcile, they are accurate, they fairly represent the performance or the position of the business. And the sixth one, poor tax compliant. Make sure you are tax compliant. The fact that you have a tax clearance doesn't mean you are tax compliant. You might have a tax clearance and the SARS come back to you after 5 years to conduct an audit. Are you sure that when SARS come back to audit you, will they not find hoaxes in there? Will they not find that you are trying to beat the system? Yes, submitting tax return, you're going to get the tax clearance. That's for sure. You having the tax clearance doesn't mean you comply. So don't just give the tax clearance to your accountant or request tax clearance. You need to make sure that the accountant prepares your tax returns accordingly. And your tax returns reflect the performance of your business. That's very, very important because I know quite a few entrepreneurs that SARS came later. And I don't know, somehow SARS always come when things are not going well. And it slap you with a big bill that you need to settle. Obviously, you can negotiate, yes, but you don't want to be there. Make sure that you start it, you put the systems in place, you put the culture of making sure that you are really, really compliant. You're not doing your financials just to get the tax clearance. The other thing that the funders look at your credit record, right, of the business and of the directors. Make sure that you pay your bills on time. Yes, sometimes there are reasons why things are happening in a certain way, but you must have very, very good reasons why. If you are listed, why you are listed. I know GFIs, they don't check much the payment profile. They check if you are listed, which is the big thing. But the banks, the private banks, they check your profile, your score, to see how well you maintain your account. So just to be safe, just to make sure, you might not be needing funding now, but just make sure that you maintain a clean creditors repayment so that when you need funding, you don't know when you might need it. Actually, when you apply for funding, it's when you really, really need it. So don't not pay your bills on time. Make sure you maintain your healthy credit score. Okay, and now the eighth one is, this is a pandemic. Small businesses are mixing their personal and their business banking transactions. There must be separation there, clear separation. Remember, your business is an independent legal entity. You are a person, a separate legal entity. So any transactions between you and the entity, they must be clear, they must be explainable. You don't just swipe the bank card of the business when you're buying groceries. You need to make sure that you do proper transfer. If you are earning a salary, know how much you're earning, you transfer it into your personal account, you use your personal account for personal things, and use your business account for business things. If it happens that you're using the other card for the other, make sure they are properly accounted for. But where possible, avoid mixing your personal bank account with the business. You are two separate entities. You can't take the card from the guy next door and go use it. That guy is a separate person altogether. So treat your business that way. Because if you are mixing them, you might it makes sure it affects how you account, your accounting records, how your business is performing. 2, you don't know if you are performing well or not. And then the last one, which now I'm raising it because it's one of the points here, is to say when you apply for funding, the funder will look at that. And it will show that you don't have systems in place. And if you don't have systems in place, that means you can't run your business professionally. Then you're decreasing your chances of being able to secure funding. And the other one is call it poor market tactics, where the business is just not performing. If the business is not performing well, you won't get funding. It's simple. There's no funder that wants to lose their money. So you need to make sure that you do marketing properly, make sure that you grow your business, the turnovers are showing, go get into the market, make sure that you're achieving the necessary margins. Don't grow the business for the sake of it. You must make sure that you grow your business with profitable customers. So that if you want to expand, then you approach the bank, you'll be able to show them that I'm expanding and I'm expanding profitably. Otherwise, you'll be expanding but making losses, and you'll struggle to get funding to support the growth of your business. Okay. That is the end of our session today on finance a new venture. We looked at the funding options, we looked at the funding institutions, we looked at the document that is required for you to raise funding. We looked at how you must look at how much you need for your business. And lastly, we looked at the problems that causes entrepreneurs struggle to raise funding. So that's the lesson. And for you, just as an entrepreneur, into your formative assessment, call it, you just go check in terms of your funding needs. What funding do you need? Have a list supported by quotations and supported by your business models and your revenue that you are projecting. Identify the type of funding that is suitable for your business. Identify the funding institution that you're going to approach for raising capital, and then make sure that you keep records that are required when you apply for funding. Make sure that they are always ready. Those records are not only required for funding, but are the records that needs to be maintained by all businesses to make sure that you don't know when the opportunities can come. I remember recently we had the CEDA wanted us to recruit certain businesses to give them grant funding, but they didn't have their bank statements or bank accounts. They didn't have permits. Tax clearances were expired. They don't know where to find their company registration document. And that was an opportunity missed. But if they had made sure that they maintained their records, not saying that they would have gotten the grants, but they had a chance that they could have secured grant funding from CEDA. So make sure that you maintain your accounting records properly. Not only accounting, but your business records. You file the way you're supposed to file. You make sure that you know where you're finding your document. So just check that. Make sure that the documents that have been listed during the session, that you are kept, they are safe, they're easily available, and they are not expired. I thank you. Bye.